Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So due to Memorial Day, we have the EIA tomorrow, so we'll have the Econ Show today. So the Econ Show is going to be a lot shorter than it was last week, because last week we were trying to do 2 weeks in one. So this will be, go through things a bit, but we do have some new data that we do find interesting, and we want to, help keep people abreast of what is happening. So when we start looking at the global side, as we like to do on the first segment, we're going to look at the central banks tightening. We want to do an update on what's happening with Russia, Ukraine, just because there's new rumors of what they're going to try to do with getting food out of Ukraine and into the market. We want to look at what's happening there. We also want to look at how central banks continue to tighten on a global basis, and what does that mean for credit impulses, and then how is that a leading indicator of what comes next. Then when we go to the next segment, the Fed quantitative tightening starts this month, but again, what does that mean? And then at the same time, we want to look at what is happening with inflation and why Fed quantitative tightening is happening, why we don't see it slowing down, and we do think they will keep to their current schedule. Then we're going to look at how the consumer has weakened, and in terms of what their buying power looks like. But we also really want to show what is happening on the housing side, what is happening with the underlying market, because we continue to see a lot of cracks in that market on the housing front. Then we want to look at EU inflation, which continues to break records, and how that's going to shift what is happening with the ECB and what the different rates are going to look like. And then we're going to talk about China. The data did improve; it's still contracting, but that is obviously a positive. But we also want to look at how is China going to stimulate? Because we've seen what they've talked about. We talked last week how they've identified stimulus, but it doesn't mean that it's really going to hit where it's going to hit, because again, as we've talked about on the bond side, it's not so much a supply issue, but a demand issue, which is, I think, a bit different in terms of how things look in the market. So getting to what's happening in Russia right now. So when we look at this, is as of May 31st, you can see just in terms of who this is coming from. When you look at the International Cyber Policy Center, Russian forces have advanced forward troops significantly into the city of Severodonetsk, so just essentially northern Donetsk in terms of where the city is. And you can see that there's a lot of activity around that area. And it's one of the things that the Ukrainians continue to do, and they're using it to their advantage, is they have a quick retreat. So they give up land for time, force the Russians to essentially extend themselves, and then try to strike the rear and really create some of these different problems for their supply chains, for their movements. And what they've done in Luhansk, in the Severodonetsk, is when you look at what they've done is they're drawing in the Russian troops, forcing them to go block by block on the assault on the city, which is obviously going to be devastating. I'm by no means downplaying that, but there is a certain amount of strategy within that in terms of inflicting as much damage on the Russian troops that are coming through, on the equipment, forcing them in, then launching counterattacks, especially on the back end of the city, which is what they've done, especially in the north, when you look at what has really forced some of that retreat. Now, you can see some of the gray areas, which are areas that are unknown, haven't really been cleared from the Russian invasion, as the Ukrainians are making steady progress trying to, disarm any booby traps that were left before people move back in. Now you can see areas that remain part of Russian control, but there's also those gray areas where you can see that there has been pushback. Obviously, there's some strips where Russia has been able to cut off and surround different areas, but there continues to be a push in terms of trying to reconnect. So there have been some vague but significant claims of progress from Ukrainian forces along the axis, very little of which has been able to confirm. So right now you can see in Snirvaka and Voskopola are two areas, as you can see, that languages, even English is a struggle for me, let alone Russian and Ukrainian. So when you look at some of these two areas, there continues to be a lot of infighting around that, where Ukrainians have made some progress. So again, even though there's been some movements from Russian troops, there's also been some pushback, which the Ukrainians have been able to retake and slow this steady move. And the reason why we're talking about this right now is because you can see on the Black Sea on how there still remains a significant amount of, if not all, of that remains under Ukrainian control. So now there's more conversation with the UN trying to broker a deal through Turkey between Russia and Turkey to get Ukrainian crops out. So it wouldn't go, obviously Russia would love for them to go through the Sea of Azov, but there's no reason to, because it's like, well, the Ukrainians are going to want to control this the whole way through, ensure that money comes into the right area. But there is a blockade on the Odessa, which is one of the key areas, especially right on that border. That is a huge exporter of Ukrainian crops. So that's something that they're going to look to try to get in. Yesterday, you had the big drop in grain prices on that belief that there was going to be some of that food coming on the market. But the question is, how quickly does it get it on? How much is actually available? Is there going to be Ukrainian personnel to get it onto boats? Are the boats going to be captured and then moved over to Russian control? Again, there's a lot of unknowns when we look at how this is going to progress. But there is a dire need for that food in the market. Now, I appreciate beautiful charts for those that have been following us. And this is, I thought, a really good one that goes back to November 21st. November 2021. So it's just taking kind of a snapshot in time so you get an idea of where Russian crude is going. So you can see that there's some countries in here that aren't on there, like India right now has seen a huge increase of imports, but they're not on this list. And it's just because this was a snapshot in time. So, but it's also imperative to think about, okay, well, Germany, Netherlands, when you look at OECD Europe, which was taking 4.5 million barrels a day, that's going to be replaced. Some of that is going to China. Some of that is going to India. Some of that is going to other Asian nations. So that's where you're seeing some of those shifts. But when you look at 60% of Russian crude, oil, and refined exports, we're headed to OECD EU countries. So that, and the reason why we talk about this is because the about 90% of Russian crude is going to be sanctioned and not allowed to be sold in the European region, which is why you get an idea of how much was going there, how much has to be moved over. We talk about this every week in the EIA show, but I think this was a good chart that we wanted to get out there, show that it exists. The S&P Global put it together, and you get an idea of how much stress Russia is going to be under in order to try to get this to get into the market, which is why we've seen a huge discount of Urals to dated Brent at about $36 to $39, because they're trying to get it away from Europe and just into the market where some of these areas, especially China and India, can demand a discount for what is coming into the market. Now, when we start looking at credit impulses, you can see that the global sentiment continues to weaken, but it's really on the back of that credit impulse. So when you look at where the impulses are going, and that's just looking at how much credit is transacting, how much credit is coming through, how much new credit is being created, you're getting an idea that there's a big slowdown. And typically, when you see these type of slowdowns, as we saw in 2011. Through 2012 and through different slower periods, there's a bigger risk to the global economy, and it's really weighted towards China, US, and Europe. So when you look at some of these OECD as developed markets and then China, how that continues to slow, how it's pulling down a lot of that demand because you're losing a significant amount or a big chunk of, with China being the growth engine on the manufacturing side. And then Europe and the U.S. as the big buyers, especially the U.S., as that slows, that's going to pull down a lot of this expected growth. So then when you look at the central bank rate hikes eventually weigh on PMIs, there's a time lag. It's not like the rates go up and people instantly stop buying. It's a compounding effect, because as you get new rates going up, then people can't borrow as much. Their credit card rates go up. Their other rates, there's an ancillary piece, and there's a cascading effect that happens starting with the Fed funds rate, the risk-free rate, the central bank rates at the local areas, and how that cascades down, which is why you have, as more tightening happens, that's when you get a more and more pressure on the global PMI. Companies can't borrow at the same rates. Companies slow down in general, and that's where we continue to see some of those hits. U.S. PMI versus global monetary policy cycle, that's where you can see the U.S. PMI is just going to come, and you can see that it typically follows the trend. It's not, it's not lockstep, but you get an idea of the trend in which it normally follows. And that's something that we'll talk about in segments 2 and 3, how we've continued to see that go through the same paces. Globalization continues to, again, not to say that we ever said it was dead. One of the things that we've been saying is nearshoring, onshoring, but really nearshoring is becoming a much bigger theme when you think about repositioning on a global level, but it takes time. This is not something that happens overnight. So world trade volume will continue to be fairly stable. This is through March, so obviously this doesn't pick up what happened in China. So this will dip, as you saw in 2020, and a lot of that was driven based on the issues coming out of China, which was, if not the same, then greater than. So we will get that dip. There was already movement and preparation for that. Inventories had been built up, so inventories were in a different place. You had more pull from ASEAN and other Asian nations, so we don't expect the same type of drop. But again, you're still going to see that soften as you come into the end of April. But really May and June, and then so far based on just timing, July is where you'll see a lot of that bigger hit. Now, when you look at the persistent drought effects, more than half of the U.S., I think this is just important to appreciate in terms of just the drought issues that continue and how they've only gotten worse since 2019, as we've been talking about. For those that have been following us, end of 2019, we got a bit bearish on just crop yields, the pressure that we continued to see, and now we're seeing some of that pressure continue, especially when you look at the West Coast. So when you look at California, they're expecting hydro to drop again just because there was a fairly weak snow melt. And that's going to create essentially cascading issues, as you can see, through the whole state for the most part. As the reservoirs aren't refilled, the hydro will have to slow down, and then that means that there's going to be a higher natural gas burn, and they're estimating about an increase in 5% on electricity prices, which is likely to go higher just given the pressure. But when you look at the area in general, you can see that the extreme droughts continue to hit and then bleed further north, impacting a lot of the breadbasket states. And as the breadbasket states get hit, that's where we continue to see a lot of the problems that we've been talking about in regards to the problems that we're seeing on the U.S. planting. So when you look at winter wheat conditions, you can see it's one of the worst ever. U.S. corn planting has gone up at the same rate of change, but at a marked step down. And that's the biggest issue that we're seeing is, yes, it's moving up, but it should be much higher, much better. And you can see 2021 was a very low year. Soybean planting, something similar. Spring wheat, something to say the same. So wheat prices dropped sharply on Tuesday, as we talked about on hopes Russia will allow seaborne exports from Ukraine grain. But when you're thinking about that, which was what drew that down, spring planting of U.S. wheat picked up last week, but remained at a record low pace, while the winter crop condition at 29% remains the worst in 16 years. So again, those are the pressure points that we keep seeing coming from the U.S. Now, it's not immediately clear which Ukrainian ports Putin was speaking of, but the ones that Ukraine would look for is Kherson and Yuzhny is already either, Kherson being in contested areas, a lot of fighting. Yuzhny is another one that is over in the Russian-controlled area, but Odessa is a key one that would be used and is outside of Mykolaiv. That was the second, Odessa was the largest, Mykolaiv was the second largest. So again, there's still opportunity for Odessa to continue, but it doesn't mean that you can get past the blockade. Now, on May 29th, U.S. corn planting was 86% complete, tied with 2011 for the second slowest pace of the 21st century. In 2019, only 62% of the intended corn acreage had been planted by May 29th. So again, there's some of those different pieces in terms of where we are, and that's why, as we've been talking about, 2019 was where we saw that bigger pivot that continued to get a bit worse. Now, some of the good news that has been out there is the falling commodity prices. So the view is that you're going to get these falling commodity prices, and that's going to ease some of the food inflation. But for those that saw the UK information, they're replacing sunflower oil just because they can't find it. It's expensive. A lot of that comes from Russia, Ukraine, so it's not going to Europe, and a lot of that isn't going to India as well. So yes, there will be some flatlining, but one of the things that we've been talking about is, and I think we're of the consensus as of May 25th, that we continue to go up and then we go flat. We just don't think, as you can see here, there's a fairly sharp drop. We don't really expect to see that sharp drop. We expect that to get to a level and then kind of hit this crest and then just go sideways. It'll gyrate up and down, I mean, as most commodities do, but we don't see a huge reversion back down. And even the estimates, there's not a big reversion, but you can see that there is that drop. We just don't see it as sharp and more of a gradual type move holding at some of these highs. So that's what we have for you on the global side. On the next section, we're going to go deeper into the U.S. data and what is happening within quantitative tightening and what the Fed is going to do over the next few months.